We just closed the books on a rough quarter, but we're starting April with a little bit of hope. So the question now, is this the start of a real recovery? Daniel Deming is managing partner at KKM Financial and joins us now. Dan, great to have you on.
Hi, Caroline. Yeah, great to be on.
So we had that massive rally yesterday, Dan. Stocks are kicking off April with more green. What's your call here? Are the lows in, or do we still have more downside ahead?
I tell you, Caroline, I think the first test for this market's going to be the moving averages, particularly that 200-day moving average, which is floating about 1% above the market right now when you look at the S&P and the NASDAQ. And I think I could see us going up and challenging that, but I think that it's going to be a little hesitation before we see any meaningful push higher. As again, even though we're seeing commodity prices coming down, particularly crude, for the short term, I think at these elevated levels, some of the damage is going to linger for an extended period of time. And I think it's going to be a challenge in the second quarter for the market to push to new highs.
So hard to push to new highs, but we have an S&P 500 that's about 6% off the highs. But how should we be thinking about the lows? Because we're quite a bit off the lows, right? Do you see more downside in store then?
I think there's a potential that we could test the recent lows here before we find a meaningful bottom. And again, it's dependent on some of the dynamics in the market. Certainly the situation in the Middle East is driving the price action right now to a large extent. And, that uncertainty, even if it gets resolved, I think the lingering impact here, as it's extended probably longer than what the market had anticipated, is going to continue to be a disruptive factor moving forward, particularly in the supply chain, Caroline. I think that that's being underestimated at this point, that there's damage that it's going to linger into the summer, keep inflation elevated. And I think we're also seeing the labor market soften. I think it's going to continue to soften. So those are two major headwinds for the market from a valuation standpoint and a pricing structure standpoint that not necessarily lend itself to a potential for new highs until I think we see maybe a little bit more consolidation here near the lower end of this range.
Dan, do you do price targets? Do you have a price target for the S&P by year end?
I mean, we're still optimistic that it's going to break to new highs, but I think it's going to be later in the year. I think, the short-term price target right now for me is 66.39 in the S&P. That's that 200-day moving average. That's about 1% above where we are. That's going to be, I think, a critical level if we drift back up there. If we get back above there and find some meaningful momentum in the market, then the bottom, technically the bottom's in. But I think that right now, Caroline, when you look at the short-term aspects of the market, that 200-day moving average, both in the S&P and the NASDAQ, are critical for this market moving forward.
Okay, let's talk about some specific sectors of the market. Energy, of course, has been the best performing sector so far this year, with oil prices just below $100 a barrel right now. Is that too crowded at this point, or is there still opportunity there? How are you thinking about energy?
To me, it's a little crowded. Again, if we see an extended period in the tensions in the Middle East, and particularly shipping and transportation through the Strait, continue to be challenged, then if crude does break out to new highs, then certainly energy is going to follow and the energy stocks are going to follow. But at this point, hovering around this $100 level, it does appear that it's found, at least for some short-term, equilibrium. And if we do see a resolution in the next month, let's say, and we do see some softening of the tensions between the shipping in and out of the Strait, that eventually that will certainly have an impact. Again, I think longer term, that's going to, from a short-term perspective, I think it's still going to have an impact over the next quarter. Longer term, it will get worked through the system. But I think, looking at it right now, Caroline, energy does feel a little crowded. I think there's other sectors where we're seeing relative strength that don't necessarily get the attention that they need.
Dan, is there a level for oil that the market essentially needs to be able to move meaningfully higher? Because I think that despite the fact that it is well off the highs, it's still up 70% year to date,
Yeah.
U.S. crude is. So at what point does oil need to get to see a sustainable market rally?
I guess it's really a perception. I mean, certainly $100 from a psychological standpoint, I think is a critical level. I think it probably needs to get to about $80, Caroline, for it to be meaningful as far as shifting the expectations and the impact on the inflation front moving forward. So really, I think when we kind of evaluate it, to us, I think $80 the market can digest that for at least for a short period of time. And a build off of that, if it holds above there for an extended period of time, I think that's going to raise the inflation parallel pretty much across the board. And that's going to be a challenge for the Fed moving forward. And that's going to have an impact, I think, as far as expected valuations and the potential impact on the economy moving forward.
So we have energy at one end of the spectrum, and then we have tech, which has been one of the weakest areas of the market so far this year. How are you looking at that?
Oh, yeah.
Is that a real unwind of the AI trade, or are investors just rotating into other parts of the market and they'll come back soon?
I think it's a rotation, Caroline, because if you look at how this market's reacted, if you look at like equal weighted strategies, even if you look at the Russell, up on the year, equal weight strategies up on the year by and large. So to me, that's a rotation, because even though you're seeing significant damage in the tech sector, certainly looking at Microsoft being featured, worst quarter since 2008, now a valuation level below the S&P. So you've seen some significant damage there this last quarter, but yet the market's really not off all of that much relative to the damage that we've seen in the Mag 7. So to me, it's more about a rotation going into some areas where it's been defensive. Certainly energy has picked up some of that slack. But if you're looking at other areas in the market, certainly materials continue to hold up well, utilities holding up well as biotech. And even in the tech sector, in its own little area there, well, not little, it's large, but the semiconductor area has weathered the storm pretty well.
So when do you expect money to start flowing back into other areas of tech that have been pretty beaten down, including the Mag 7?
Yeah, I think that we're getting pretty close, honestly, Caroline. I mean, when you see, certainly when you see the VIX going up to this mid 20 level, it's been highlighted that this has been a very orderly decline in the last month. But looking at those big names, particularly when you have the focus on Microsoft, the worst quarter since 2008, to me, that's a headline that tells you basically, okay, maybe we're nearing a bottom here for some of these names, particularly in the software area. So I think that there's going to be opportunity here in this quarter to look at some of these beaten down names and rotate back into them. So I think that, overall, that's areas that we're focused on moving into the second quarter. If we do see continued weakness, that eventually we do feel that there'll be a valuation level there where it's going to be compelling to increase exposure to some of those areas.
What areas look attractive to you right now? What's on your shopping list, Dan?
Right now, utilities. I think that's one area because we still have a great deal of uncertainty surrounding the interest rate environment. I think, when you look at relative strength, the materials area is another area where you have some names that are holding up pretty well. When you get into the tech sector, semiconductors is still the area of strength, and I think that that's going to continue to be a theme even as we move through this transition and from out of other tech areas. But again, semiconductors are a sector that's held up very well in this rotation in the market.
We have gold that's pulled back pretty sharply in March. It's down about 15% from the highs. Is that a dip you would buy?
I think eventually, yes. I think you're looking at gold and silver coming off, now trading back down to the levels where they basically began the year, and taking out some of that froth and some of the, again, the rotation that took place based on the concerns of the conflict breaking out, and some of that's now coming out. The dollar certainly is having an impact there too, as well as interest rates. Now, rates appear to, at least for the short term, have peaked. Now, we'll see how the Fed manages this shifting dynamic between inflation and labor markets in the next couple of months and even into the next quarter as to how they're going to interpret and, I guess, talk about how their policy is going to be moving forward. Are cuts still possible? Now, we did have some dialogue in the last few days that cuts still could be possible later in the year. So that's shifting the tone a little bit. And if that's the case, then in theory, that should benefit gold and silver, particularly gold. So I do think that longer term, I still think that gold's something that should be held as a diversification type of holding in a balanced portfolio.
Okay, so Dan, bringing it back to where this market could be headed, if the war was out of the picture or does have a resolution relatively soon, President Trump had said we could be out of Iran in a few weeks. That seems to be, kind of reigniting optimism in the market today.
Yeah.
If that is behind us and we do see oil prices come down, can you make the case that this is a market that is fundamentally solid enough to move higher from here?
I think you can make that case. Now, yes, I do think you can make that case. And certainly we still think that the market's going to be higher at the end of the year. Now, as far as what the price target is, I think there's too many variables out there to really pick a level. But I think there's short-term damage. We still expect it to last through the second quarter. Again, because of the disruption to the supply chain. I think that the inflation is going to be underestimated for the next several months, and that's going to have a lingering impact as far as valuations and expectations for the market. However, moving in the second half of the year, if we do see this work its way through, some clarity coming back into the market, some of the uncertainty work its way out of the market, that there's an opportunity for this market to continue to find higher price action. I think the one thing that is very interesting that you highlighted just previously is that you've got the big names that have led this market the last couple of years really coming under pressure, really in the fourth quarter of last year and then more so in the first quarter of this year. And yet the market really isn't down all that much. I mean, we touched into what they call bear territory briefly, whatever the 9-10% decline. But overall, now that we bounced off that, we're really only down about 4.5% for the year in the S&P. Given the fact that we've seen tremendous damage in those names, to me, that bodes well longer term for the market.
Yeah, I saw an interview on CNBC with Warren Buffett yesterday, and he basically was like, S&P down 7% from the highs. This is nothing. He likes down 50% to put money to work. So I do think that perspective is important. But given the fact that you don't necessarily think that the volatility is behind us yet, what should investors actually be doing right now? Should they be leaning more defensive? Should they still be putting money to work right now?
I think that, they can do both. Honestly. So I think that there are opportunities. I think that it should be somewhat defensive in the thought process as far as the allocation. Again, a broad spectrum is something that we certainly are believe in as far as when we construct portfolios, and equal weight is another theme that we focus on when we construct portfolios. So there's an opportunity here to find some equal weight type of exposure in the market and counterbalance maybe, if you've had areas that have sold off, like for example, let's take IGV. Okay, certainly it's suffered severely this quarter, and that's holding those big names that have underperformed. Now, again, there's a chance here longer term to potentially rebalance. Again, this is a longer term outlook, not short term. There still could be some damage for IGV and those big names over the next quarter. But you're seeing, you're picking up some of these really strong, historically strong names at what appear to be discounted levels. So, there's opportunities here to look to pick up some of the beaten down names, going into the second half of this year. And again, and technically increase your exposure, but also kind of rotate it out of some of the areas that maybe have outperformed, which energy would be one.
Okay. All right. We will leave it there. But before we let you go, we like to play a rapid fire game of this or that. This is your first time playing. Are you ready for some quick questions and quick answers? All right. Here we go. Stocks. Out of the woods or not yet?
Not yet.
Q2, better or worse than Q1?
Sideways.
Oil prices, peaking or heading higher?
Peaking.
Energy, safe haven or overcrowded trade?
Overcrowded.
Volatility, finally settling or a VIX bomb building?
Finally settling.
Buy the dip or wait for Q2 to play out?
Latter. Wait till Q2 to play out.
Stay defensive or lean into risk?
I think lean into risk in the very beaten down areas.
Better defensive play, utilities or treasuries?
Utilities.
Which do you like more, utilities or materials?
Utilities.
Better safe haven, gold or cash?
Gold.
Gold or Bitcoin?
Gold.
Rotation, early innings or already playing out?
Already playing out.
Best sector bet right now?
Oof. I'm going to go with utilities.
Sector you would avoid?
Energy.
Sector you'd avoid that's not energy?
Communications.
Tech sell-off, real unwind or healthy rotation?
Healthy rotation.
Equal weight or market cap weight?
Equal weight.
What breaks first, inflation or growth?
Growth.
Fed, forced to move or staying on the sidelines?
Staying on the sidelines.
One word to describe this market for the rest of the year.
Challenging.
Daniel Deming, managing partner at KKM Financial. Great job. Thanks so much. Appreciate your insights.
All right. Thanks for having me, Caroline.